welcome on board Gautam Duggad. Gautam, hi, good morning. Good to have you on the show. Gautam, what does the Indian investor do in this market? Because all the flows seem to be going into the primary market. And look at the kind of IPOs and the new paper that's been hitting month on month pretty much.
Hi, Aisha. Thanks for having me. Yes, you're right. Market has been treading water for last 12, 15 months. We did see some up of late. But I think what is also happening at the same time, the government and RBI have taken a series of measures in the last 6, 8 months. I think the positive effect of that will manifest in second half of FY26. Second, we've seen some earnings revival in the quarter that just went by, wherein the broader markets have done well. After 5 quarters of earnings downgrade, we've not seen a downgrade this quarter. We've actually seen an upgrade. And last but not the least, the valuations, which had become frothy in some pockets a year back, given the period of time correction that we have undergone, in some pockets now the valuations are looking a bit more reasonable than where we were. Of course, the mid caps and small caps still trade at a premium, but mid caps are punching in growth, which is at least 2x to 3x above the large cap indices. So I think it's a matter of time before the market recognizes the improvement in underlying operating fundamental parameters. We've had a very good 3-4 years between FY20 to 24 with a 20% plus earnings compounding. Then last 1 year has been flattish, and now we are again, after a period of 5-6 quarters of absolutely flattish earnings, are looking at things reviving a little bit to about 10-12% kind of a growth. So yes, investors who've undergone this period of stagnation of last 15-16 months, especially the ones who've entered recently in the markets, for them this has been a new experience because they've only seen 3-4 years of relentless rise. So in a way, this is good for the markets. It has cooled down things a little bit and prepared the foundation for next leg of rally.
Where is the next profit pool going to get created? And more importantly, will it be coupled with valuation comfort?
So Aisha, look, the big profit pools in India, they've not changed much in the last 25 years. The 3 segments which comprise the largest segment of the profit pool, more than 2/3 of the profit pool, are financials, consumption, and technology. Now, these are a very broad segments. Within that, you have to take a deep dive. Now, till the last 1.5 decade, you've seen banking driving the large part of the profit pool within financials. In the last 7-8 years, new segments within BFSI have opened up and created new streams of profit pools, which is non-lending financials, so like insurance, capital market, broking, exchanges, wealth management. You've also seen the lending NBFCs adding more heft and size to the profit pools. Within consumption, things have stepped away from staples towards discretionary. In fact, in staples, there is not a single consumer company for last 10 years which has compounded revenues at more than 10%, right? So whereas the wealth got created and profit pools got created in consumption, it's all in discretionary. And as we move towards $4,000 per capita, I think the discretionary segment is going to explode. And more profit pools, more and more wealth creators are going to emerge from that segment. And third, which is the technology. Now, we are seeing a lot of new listings happening in technology, where things have been pretty fast in terms of top line growth, but patchy in terms of profitability, and rightly so, because they're still in the investing phase. As we move forward, say next 5 years, 10 years, things like quick commerce, health tech, internet, that is where new segments of profit pools within technology is going to create it. The other segments, then you have commodities and all, they will keep fluctuating. You have infrastructure, they will go through their cyclical troughs and crests. And then you have healthcare, which has been far more steadier. In fact, even within healthcare, you have seen the market share, profit share, wealth share, or market cap share shifting away from the traditional generic kind of companies towards hospitals, diagnostics, health tech, those kind of things. So the profit pools keep evolving as the economy keeps changing. So when we were a 1 trillion economy, you had very little to choose from in these 3 different cohorts. Today, at a $4 trillion kind of a GDP and a $5.5 trillion kind of a market cap, the choice that investors have for long-term wealth creation is immense.
Gautam, I'll take a step back. I'll try to zoom in on those Q2 numbers because it's probably an inflection point, right, of sorts that we are seeing in terms of earnings. the stronger performers: oil and gas, cement, capital goods, telecom, chemicals. I'll focus on the first two, oil and gas and cement. Those were the real outperformers, right, in terms of the earnings growth that we saw. Uh, uh, what can you tell us about cyclicality in some of these sectors and sustainability of these numbers, especially on the oil and gas front, given that oil prices have been muted and that's what's really supporting earnings? Do you believe that some of these may actually see a bit of churn in terms of the kind of performance they've shown in Q2 versus what we'll see in H2?
So look, there is nothing called as sustainability when you look at the profitability of commodity sectors. They keep fluctuating. So cement is having a very strong year in FY26. But when I look at the annual profit numbers of cement in our coverage universe, it's a pretty wide coverage universe that we have in cement. FY26 profits will be just about similar to FY22 profits, because FY23 was good, FY24 was bad, FY25 was bad, then FY26 is good. Same thing applies to oil and gas. In fact, oil and gas results are a bit of a deception, because they are led by three OMC companies. If you look at our coverage universe, the oil and gas profits are at 40% or rather 38%. If you exclude those three OMCs, then the profits are down 4%. So very difficult to say, especially in oil and gas, whether the profitability is sustainable or not, because it is dependent on multiple things: the commodity prices, the crude prices, government policies, and all. So you have to always take a cyclical and a trading bet in that sector. As far as cement goes, there is a bit more stability out there because the balance sheet has improved. There's been a lot of deleveraging which has happened. So slightly more sustainable. And given that the underlying drivers of cement consumption are still robust, infrastructure, housing, and government capex, I think cement has a slightly better predictability. And it's risky to always say sustainability in this kind of sectors, but yes, predictability can be slightly better in cement, and we prefer cement over oil and gas and metals.
Gautam, the other sort of question right now is whether or not it merits to draw the AI comparative here in India equity markets. Should you be looking at data center plays? Should you be looking at power? Because there aren't many, direct sort of correlatives to the AI story right now here in the listed Indian pool.
Yes, Aisha, I concur with you. There are not many direct plays available. It's not necessary to play the AI trade in India because every market has different drivers. Today, we may not have the AI plays. Hopefully, in a fullness of time, say 5 years, 10 years down the line, you will find enough AI plays. So today, you have to play it in a roundabout manner. For example, 20 years back, if you had looked at other markets, there are a lot of plays on wealth management, asset management. We didn't have them at that point of time. In fact, we didn't have an insurance company listed 15 years back. But 2016-17, the trend began. And today we have 5-6 insurance companies listed. You have general insurance, you have AMCs. So I think things take time. And as they evolve, when the economy grows to a particular size, the investors will get a chance to play those themes too. But today, it's not available, unfortunately, to have a direct play in that segment.
Okay, Gautam, thank you so much for coming in and speaking with us this morning. It's been a pleasure, and it's great getting that perspective on how you're seeing markets going forward.